We participate in all segments of commercial real estate. We do industrial properties, retail properties, and the office sector. And I'm going to give you an answer regarding each sector, because they're all at different stages. But let me first start saying that if you look at rental rates in Mexico, they're relatively low compared to similar development countries. And we have a general view that these are going to increase for two reasons. One, demand, and the other one, that the replacement values have gone substantially higher. If we look at the retail sector, that is the most dynamic sector, and that one, we have been able to increase the renewal rates of our rental contracts at a pace about 2 times inflation, or sometimes higher, depending on the location. And so that's very strong. It's backed by the increasing consumer demand in Mexico on the one hand, and by new brands coming into Mexico, such as H&M, Bed Bath & Beyond, Crate & Barrel, Old Navy, etc. So that one looks very well. If you look at the industrial sector, we have 2 types of properties. One is light manufacturing in the northern part of the country, where there's little scarcity value. We're not expecting rents there to increase. However, there's sufficient demand to rent additional properties. And if you look at logistics, what has happened in Mexico is that the price of land has gone substantially up. And that has helped rents increase. And that one is also, we haven't been able to satisfy demand at the cost that we think is attractive. So we're working hard on trying to have enough space for our tenants. And if you look at the office space in Mexico, that's where supply and demand are almost equal. We're not expecting, in dollar terms, rental rates to increase, but because there's a lot of supply coming into the market. So this is a thing that we think is going to last about 18 months. And then we think that if you have a well-located property, rental rates are going to go up. So we think it's prospects are looking very well. We're, at this point in time, following 2 strategies. One, we see volatility coming around, some uncertainty. So we're trying to keep acquiring properties, which we have been done since inception, because of what I described in answering the first question. And at the same time, try to keep a strong balance sheet. That means that we have to be creative in terms of how we acquire the properties. We will be acquiring many properties, taking advantage of the tax breaks that the sellers have when they sell to Fibra. So we're going to be paying most of our acquisitions with equity. And the other thing that we will be doing is we're going to go more into mixed-use developments, which are in high demand in Mexico these days. In our case, local currency bonds are less costly, more cost-effective than issuing outside Mexico, because we don't have to pay the country risk premium. So whenever we can, we try to issue locally. But the fact is that given our size and the size of the local market, given our growth strategy, sometimes the local market is not large enough for what we want to achieve. And that's when we go to US dollar denominated bonds. If you look at our income, we have 70% of the rents that we collect are denominated in pesos, and 30% are denominated in US dollars. We try to keep a ratio of dollar income to dollar expenses higher than 1.5 to 1. The reason for doing this is that we cannot monitor the risk to foreign exchange movements of all of our tenants. So we try to keep a safety valve reflected in this excess of 50% of revenues to dollar expense. So if we go and issue a bond outside Mexico, what we would do is we would hedge any additional exposure in case we don't meet this ratio. The drivers are, we would like to increase our exposure around city in the north of Mexico City called Querétaro. That city has been growing very fast because it's linked to two industries. One, the auto part industry, and the other one, the aerospace industry. So with this acquisition, we were able to acquire properties in the Querétaro region. And the other driver for us there is that the rest of the properties were at attractive cap rates. So it is in tune with what our view of the market, and it helped us increase our exposure to that particular part of the country, which is very fast growth. Regarding the financing, most of the acquisition will be paid using equity. So we're going to exchange properties for equity of the company, and the mix is approximately 70% equity, another 20% in cash, and that cash is basically driven by additional developments that we have to do in these properties, and 10% of those properties already have debt. So that would make the 100%. It's mostly financed through equity.